Okie dokie. So mentorship day one, bootcamp day one for what's the month? August. Okay. So we will be going through, right? We will be going through on day one. We will be going through number one, ICT PD arrays, how I interpret them. Number two, external I better give credit to ICT. ICT external to internal range liquidity. Then number three, we have hierarchy of reactions, which is essentially the PD array matrix. So hierarchy of reactions, PD array matrix. Number four, we have refining points of interest. And finally, we have stop hunts, which is what? Price signature that indicates a range expansion or range creation. Okay, that's what we are going to be going through today. Right now, let me take out my trade. It's not going to work out, so close it at a small loss. ICT PDA is ICT external to internal is liquidity, hierarchy of reactions, refining points of interest, and stop hunts. Okay, now obviously everyone is already familiar with everything, but just for the sake of it, let's go through it. Just for the sake of it, right? So we know what ICT PD arrays are as explained by ICT on his YouTube and in his mentorship content, right? So I'm pretty sure to every one of you guys, his mentorship content is nothing new. I'm pretty sure 90% of you have watched his league content already. So it is what it is, right? We know it. So when we look at ICT PD arrays, right, we know order blocks, we know breakup blocks, mitigation blocks, and all of that, right? Now the question that you should ask yourself is, okay, now when are we supposed to use it? When is an order block highly probable? When is a breakup block highly probable? When is a mitigation block highly probable? Right? So to answer that question, right, number one, we need to have narrative. Okay, narrative. Now, what does narrative mean? Narrative means that if you take into account something like this from day before yesterday, we saw that price came from an unmitigated 4-hour bullish order block. That does what? That switches, right? When we see a move like this, right, it means that it switches order flow. We move from bearish order flow to bullish order flow. Okay, we move from bearish order flow to bullish order flow. So that is ICT 101, understanding order flow, and that is what understanding PD arrays accomplishes. If you understand PD arrays, you understand what the current order flow is, obviously. Okay, so looking at this unmitigated, which is now mitigated 4-hour order block, we know that when we see this reaction that we got over here, we know that it was what? It was a switch in order flow. Now, in switching order flow, what does that mean? It means that once we have gone from bearish, let me just denote it by arrow, from bearish to bullish, the PD arrays that are going to work are predominantly what? The bullish PD arrays, right? Bullish PD arrays. And these are the PD arrays that are going to work when you what? When you see a switch in order flow. When we are in bullish order flow, what's going to work? Bullish PD arrays. When we are in bearish order flow, what's going to work? Bearish PD arrays. Which is why if you zoom out, you can see that throughout the past from Monday we had bearish order flow. Why? Because price was drawn to something. What was it drawn to? This order block. So see, price dropped. See where it wicks into? Wicks into this down close candle, or you can also say this down close candle, which is a breaker. See a breaker block, price drop. So it touches the breaker block and then it moves lower. There you see price forming what here? Bearish order block, bearish order block. This is a what? A propulsion block. Now, propulsion block is a bearish order block whose high or body goes into a previous bearish order block. Okay, I'm pretty sure you guys understand, but if you don't understand, just send a message on the chat box, right? So this is a propulsion block. So when price comes into a bearish PD array, which is a propulsion block, here, what does it do? It sells off. And it sells off until where? Until this bullish order block. Then you get consolidation and then you get an expansion. Okay, now that is essentially a PD array. A PD array, we can draw them out as follows. Mitigation block, breaker blocks, okay, breaker blocks, liquidity voids, ICT calls it CB, and then you have fair value gaps. Then you have order blocks. After an order block, what do you have? Rejection block. After rejection block, you have hold high, low. Okay, this is how the PD array matrix works. Now, see, we know what an ICT PD array is, and now we are looking at the hierarchy in which they work. Mitigation block, breaker block, liquidity voids, fair value gaps, order blocks, rejection block, and hold high, low. Okay. Now, for those that are not familiar with these ideas or these concepts, right? These individual concepts, right? Listen, look closely. When you see a mitigation block, okay, I'll give you both the bullish and bearish examples. When you look at a mitigation block is a price taken into account a bearish example, when price makes a high, lower high, and drops. Okay, this here is the point in which it becomes a mitigation block. All right, this here is the point in which this becomes a mitigation block. So you would reasonably expect for price to come back here and then sell off. All right, the price to come back here and sell off. So this is the point in which you sell. You keep your stop loss here and your take profit wherever the low resistance liquidity is. Yes, it's recorded. Okay, wherever the low resistance liquidity is, right? So that's the bearish example. So when we look at a bullish example of an ICT mitigation block, we know that it looks essentially the opposite, right? We have the low, higher low, and price breaks higher. Okay, price breaks higher. So where's your entry? Your entry is somewhere here. Okay, when price breaks higher like this here is your bullish mitigation block. Your stop loss is here and your take profit is at a point where it's comfortable for you, but it should be a logical point in which profit should be taken, right? It should be a logical point in which profit should be taken. So that is a mitigation block, right? So it's more of a, how can I put this? It's more of a understanding, okay? It's more of an understanding of how it looks like, how the liquidity has formed, okay? Now remember, it's not pattern. It's not a pattern. It's not a pattern. It's an understanding of how liquidity has formed. There's a reason for price to sell off, right? There's a reason for price to sell off. A breaker, which I'm going to talk about now, a breaker and a mitigation block, they serve two different purposes. Okay, they serve two different purposes. So the mitigation blocks, right? They serve as a continuation. Okay, they serve as a continuation to go somewhere. Whereas a breaker block serves as a point of reversal. Okay, a breaker block serves as a point of reversal most of the time. Right? Obviously, it's not going to be a reversal on the lower time frame, but when you see it on the higher time frame, it shows a point of reversal. But since we're intraday traders, we can also look at it as a point of reversal from an intraday perspective. Okay, so that is a mitigation block. So mitigation block. If you see me, if you see me place an MB on my chart, it means it's a mitigation block. Okay. So if you look at any mitigation block that has happened on Euro USD on the 1 hour chart, right? You can't see it, right? All you can see are what? Breakers. See, we have a breaker here, price respects it and goes lower. You have a breaker here, break over here, but there is no significant low that it broke, right? So this is not a valid breaker. Then you have a high, higher high, break. This is your breaker, which worked out for about, I think this was yesterday's sell. So somewhere, which worked about 12 pips, 10 to 12 pips. So that's more than enough. Okay, so when you understand how it should be formed, you can easily capture trades like that. All right. So a mitigation block is that. Then when we go and look at a breaker block, right? We understand that a mitigation block is what? Something that serves as a point of continuation. Okay, it's something that serves as a point of continuation. This is high was a H1 breaker too. This is high. This is Friday, this is Thursday, this is Wednesday. Wednesday is here. Yeah, it's a breaker. Yes. Okay, so that. All right, so when we look at a mitigation block, we understand that it's just mainly used as a point of continuation. Okay, whereas a breaker block is used as a point of reversal. See, if you now let's look at how it looks like first. So a breaker block, look at the bearish example, you have a high, higher high, and then a break, right? So this here, this down close candle over here is your breaker block. Keep your stop somewhere here, take profit wherever you want it to be. Okay. Then a bullish breaker block is a low, low, and price goes higher. Stops here, and your take profit is wherever you want it to be. So let me call this SL. Okay. So like I said, these are points of reversal. It's a point of reversal. And now, if I draw something for you, right over here, now let's take a look at this example. Okay, so we have a consolidation. Price drops, boom, and now it does this. So what does this look like? What does this look like? Yes, market maker buy model, right? So what that essentially means is, here is your point of reversal. Here is how you can get in on that reversal using a breaker. Okay. Now on Sunday, this will be what we call an institutional swing point, which is a much easier way to understand things. Okay. So the institutional swing point is an understanding of liquidity. This over here, today's portion is just going to be an understanding of how these things work, what they are meant to be used as. Okay. So this is a bullish breaker in which price uses to serve as a point of reversal to go higher. Then if you look at another example, now you know what a bullish breaker is. Now let's look at a bearish breaker. So a bearish breaker is something that looks like this. We have a high, higher high, break, low. The down close candle here is your breaker, meaning that price is gonna boom, go lower. Now the question is, what's the context, right? What's the context? The context is this: even for a bullish breaker, this move down is obviously going into a PD area, right? Obviously, when you know that it goes into a PD area, boom, there's your context. The breaker is definitely going to work and price is going to go up, right? That's how we can understand. That's how these things work. They work under context, not just, okay? So here you go. We have a low, and here's a stop hunt down into the unmitigated order block. Boom, goes up. And then see the next day, the breaker works. Meaning what? Market maker, buy model. Here's your move up. Here's your low risk buy, and here's your another buy maybe, which we took today, and off it goes to take out the consolidation high here, or buy side liquidity at the point of consolidation. Okay, so essentially what does that mean? The moment price came here, it essentially served as a point of reversal to go higher. Okay, so now looking at a bearish breaker, that's my thing. Okay. If you look at this now, that's not that nice. Here you go, up, 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 one more time, and now down we go. Yeah, down we go. Here's your breaker. Here is your entry. Here is your stop. Quality tester. So then what does this look like? Someone, anyone? Remember some, yes. Okay, so market maker sell model. So what does that mean? This means that the breaker was used as a point of reversal. Right? Breaker was used as a point of reversal. Now, every breaker that you see, okay, if you dive down to the lower time frame, sorry, it's a what? Now, what does this look like? What does this? What does these guys look like? Someone care to say something? Yes, BSR, SSR, meaning what? This is your dealing range. So when a breaker is formed, right? When a breaker is formed, what is it doing? What is this point here with regard to this high and this low? Premium, right? What's this point over here with regard to this high and this low? Discount. So price comes to discount and boom, goes higher. Price goes back to premium and boom, goes lower. See? All right. So we'll talk about that later. Then are the external star market by one? Yes, you are right. Because breakers are order blocks. Okay, breakers are order blocks, and that's how it is. Breakers are order blocks. If you look at this here, this over here, from 10 o'clock on the 10th of August to 8 o'clock at the 11th of August, let's go with 4 hour, it should be an order block. Here you go. Here's order block. If you look at the daily should show an order block. No, not the daily, 4 hour. 4 hours should show an order block. So here's your order block. Okay, so this is the 11th of August. So maybe the daily has it as well. No, the daily has it on the 10th of August, right? On the 11th of August, on the 4 hour chart, we have bullish order block. Okay, we have bullish order block, and it did what it did and went higher. It went higher. Okay, so when we look at now, quick recap, when we look at mitigation blocks, we know it serves as a continuation until price reaches a PD array. Okay, until price reaches a another PD array, and then we have a breaker block which serves as a point of reversal. Okay, and are the extreme to the start of a market maker buy on like yes, you are right. Yeah, so order block, like I said, order blocks are breakers, and therefore by extension the extremes of the breaker, the stop run, the extremes of it are essentially going into higher time frame breakers. Yes, right. So then when we look at liquidity voids, right? Now this you gotta give credit where credit is due. It's not ICTs, it is Chris Lorry's. Okay, it is Chris Lorry's. Sell side imbalance, buy side inefficiency is just a simple way of saying, okay, this is a bullish liquidity void, and this is a bearish liquidity void. It's a simple way of saying that. So that's ICTs, but the concept of liquidity void is from Chris Lorry. Okay, so when we look at liquidity voids, right? The understanding of a liquidity void is basically telling you that, okay, there is a lack of liquidity, obviously, but in terms of what? In terms of what, right? Now, when we look at a bearish candle, a liquidity void as in terms of a bearish candle, we can see that, okay, this means that there was sell-side delivery, but there was no buy-side delivery, right? There was no buy-side delivery. So a liquidity void is an absence of one side of delivery. Okay, an absence of one side of delivery illustrated via a displacement in price. Okay, illustrated via a displacement in price. So when we have a bearish one, which ICT calls sell side imbalance, buy side inefficiency, the price was essentially, if you take it in terms of order placement, there was about, let's say, 10K. Oops. That was about 10K orders going down, right? And there was little to no buy orders left to get filled. Right? There was little to no buy orders left to get filled. Hence, price just boom, just dropped. Because to fill the 10K orders here, price needs to find liquidity in terms of counterparty, right? So the price needs to find counterparty liquidity. So where will price find this counterparty liquidity? At other PD areas. So where is the next level of liquidity? Here. It's unmitigated 4-hour order block, right? Which is why ICT says that price moves from PD area to PD area. Right? Price moves from PDA to PDA. That's simple stuff, right? So when we look at liquidity voids and fair value, you guys know what fair value gaps are, right? So when we look at liquidity voids and fair value gaps, right, they are best used in conjunction with these two and order blocks. Okay, liquidity voids and fair value gaps are best used in conjunction with mitigation blocks, breaker blocks, and order blocks. That is because if you don't have a fair value gap, or if you don't have a liquidity void, right, what that means is uh, that particular area of price, for instance, let's take a look at let's say this over here. You can see here this bearish candle in the middle, it was a liquidity void, yes, but you can see that this big wick over here, it offered an immediate rebalancing of price, right? It offered an immediate rebalancing of price, closing in this liquidity void. So if it closed in this liquidity void and tapped this bearish order block as well, right, price would never stop here again. Okay, price would never stop here again because this portion of price has already been mitigated. So you would want to see a liquidity void or fair value gap with an order block, because what that means is it's not mitigated, right? It's not mitigated. So that's just how it is, and that's what I've seen from my studies as well. If you see a wick, like for instance, let's take for instance this fair value gap over here. If this candle over here had wicked inside here, right, and if price continues higher, it will not stop over here. Okay, it will not stop over here because orders have already been offered here. So if orders have already been offered over here, where is the next level of orders going to be? Up here, right? Up over there. So so if price is going to go up, what it will do is go up, consolidate higher, and then go lower. Okay, that's basically how I use liquidity voids and fair value gaps. I use it with that understanding, not because it's just a liquidity void, not because it's just a fair value gap, therefore it should do this, therefore it should do that. It's just that there is an order block, there is a liquidity void, there is a breaker block, there is a liquidity void. Therefore, in order to rebalance this for instance, in order to rebalance this liquidity void, right? Price needs to come back and then grab some orders, right? So where the order is going to be grabbed from? From the breaker. So the algorithm will reprice into the breaker and then continue its expansion to take out buy side liquidity. Why? Because the buy program triggered here, unmitigated 4-hour plus OB. The buy program triggered from this spot. Therefore, price is gonna the algorithm is gonna reprice into this breaker with the liquidity void, which made it super high probability, and price went higher. Now, things would be different if this wick over here, if it was a bit more lower like this. All right, if it was lower like this, then you can see that this portion here, all right, this portion here, what happened? It's already balanced, right? It's already mitigated. This entire portion over here has been mitigated. So where is the next portion of price that has not been mitigated? Here. So if yesterday's news event, if this portion was like this would have dropped down even deeper and then gone higher. Okay, I hope you get that. I hope you get that. If not, just let me know. Right, so can you explain the unmitigated OB and the ones? Okay, let me show you. Yeah, from here to here. This is what I mean by unmitigated, right here. And also took a low shot. It took a strong low, right? So strong low taken out. So price triggers a what? Low resistance liquidity run up. But we'll dig deep into that next week. So this is what I mean by unmitigated portion of an order block. Okay, is that cool? So then that is where price was working with it before it just jabbed one more time and then boom, goes up. Would I refine on the low time? No, I wouldn't refine it, because trying to catch the bottom and trying to catch the top, it's like you're playing a game with your mind. So you might as well wait till it gives you an entry and then wait. So that's why I have the bullish and bearish algorithmic model. So if I go here and if I go to the 5-minute, right, I have my entry already over here. So we have the stop hunt down, price breaks, right? Price breaks, and although it was ugly over here, I think on the 15-minute it was something that looked good. Yeah, the order block here. Now this order block, we would say that okay, price has already been balanced, but this is a reclaimed order block. Under the right circumstances, something that has been already mitigated can be mitigated again. Okay, so that is something I'll leave for Sunday. All right. So yeah. Okay, so that is basically it with regard to liquidity void, fair value gaps. Again, like I said, if this line or if this wick was just a bit lower, right, touching this high over here, then this reaction would not have happened over here. It would have happened much lower. For instance, somewhere over here, right? So that is what you should understand about liquidity voids, fair value gaps, and what them being mitigated means. Okay, what them being mitigated means. Because if you want to be precise, if you want to be precise and trade with tight stops, you should understand this. Because if you don't understand whether a certain portion has been mitigated or not, then it's like I placed my buy, my stop loss was this size, it took me out, and then it went up. Okay, it took me out, and then it went up. Then that becomes a case of you placing your order in an area that has been mitigated already, and it was predisposed to go lower to an unmitigated area and then go higher. Okay, so these are common mistakes. So if you can see over here, this dealing range high here, right? Yes, it reacted from the breaker because it is a reclaimed order block or a reclaimed breaker. Okay, it's a reclaimed breaker under the right circumstances, meaning you see price taking this high out, this high out. So these are what? Strong highs, right? This was strong. This was strong because they led to moves. Basically, they led to range expansions. So highs that led to range expansions are strong highs. Price takes out a strong high, takes out another strong high. Then what's the what do you call? What's the context? The context is okay. Now I need to see a low resistance liquidity run to the downside. How am I going to get that low resistance liquidity run to the downside? Because if price is predisposed to go up, it won't go up just like that. It needs to go up, come down, and then go up. So going up here into this breaker here means that it's reclaiming this breaker just to reprice lower into this breaker. Okay, it's reclaiming this breaker only to reprice lower into this breaker and then go higher. And then go higher. Okay. So that's the liquidity void part, fair value gap part, and now order blocks. Okay. Now for order blocks, I personally like order blocks to look like this here. Clean order blocks, clean down close candles with little to no interference in terms of price coming back into the body. All right, with little to no interference of price coming back into the body. Like for instance, let's take a look at let's say here. This one here, this bearish order block over here, you see price goes down. And you see this bearish candle over here, it wicks back into the body, right? So I don't like that. I don't like that. So that's something I don't like because there are many circumstances in which you see this, but price just shoots higher into your stop loss and then goes lower, right? So it's like a it's like another example of a liquidity void or fair value gap. It's mitigated. This portion here, this portion right here is mitigated. Okay, this portion right here is mitigated. And then you see as the hours go by, 6, 7, 8, 9, 10, 11, 12, right? So from here onwards, we don't care as to what happens, right? So, but anyways, this is a move we got in yesterday. So I don't like to see this. But what I do like seeing is something like this. Price goes up and it creates something like this. Now, order blocks like this, these big down close candles, I like to use the 50% mark, mean threshold and lower. Okay, the mean threshold and lower. All right, the mean threshold and lower. Then another example would be here, mean threshold and higher. Okay. Now this is not something I would have used. I'm just showing an example. So mean threshold and higher, mean threshold and lower. Then in terms of an order block that looks normal, I would say something like that's my something like this. See, this one never really came into the body, so something like this and something like this. That's what I would consider as a proper valid order block. And yes, it would be helpful if there's a liquidity void as well. It would be very helpful if there's a liquidity void as well. If not, then it's just, you know, you playing a game of, is it going to react from here? Is it going to react from there? Blah, blah, blah. Right? So when you have a liquidity void and an order block, you can almost guarantee that there will be some form of sensitivity like yesterday. See, price just drops and then boom, goes up. Drops one more time, boom, goes up, right? And then we lost volatility because we went out of sessions. Okay, we lost volatility because we went out of sessions, right? So that is that with regard to liquidity voids, fair value gaps, and also order blocks. Now, rejection block, I'm going to skip it for a bit, right? And we'll move to all highs and all lows, right? So now, since we're going through the mentorship again, the boot camp, right? I would advise everyone that's new, right? For the guys that just joined last month or last month. When you look at all highs and all lows, I mean previous days high, previous days low, previous weeks high, previous weeks low. Right now, those are for, you know, daily range expansions, range expansions and weekly range expansions. But then what about the intermediate short-term old highs and lows? For instance, something like this high, this high, this high, right? See, this highs got taken out, and then you can see that you did get a reaction, right? You did get a reaction. So this portion of the teaching, right, I would advise you to study that yourself, right? Old highs and old lows. This is something I gave everyone as well. The previous members, old highs and old lows. I asked them to study 15-minute breaks of structure, 1 hour breaks of structure, and then dive down to the lower time frame and see, did these breaks in structure, right, offer you a trade in the opposite direction? Okay, did these breaks of structure offer you a trade in the opposite direction, right, that would meet your daily target or your target for a trade? Like for me, you know, it's 10 to 20 pips. So if this goes down by at least 10 pips, then yes, it met my target because it took out an old high and now it will drop for 10 pips. Then I met my target. Good. So that's something that'll work, right? So now there is yes, sir. Yes, sir. I want to see it come to here, somewhere here. So my take profit, I don't think I set my take profit. Let me just set it soon. Set it to right here. Okay. All right. Okay. So that's that, right? So your homework, if you choose to do it or not, I don't know. It would be obviously it would be better if you do it. Would be to study the old highs and old lows, the reactions, right? Because there's a lot of trades. You see, took out an old low here, price made a big move up. Took out a high over here, and then it made a move down. Now, for my model, does this offer me a trade? Yes, 14 pips. So I take majority at 10 pips and then let the rest run, right? Then price comes here. We all know we got into this. Here, see this high here is a strong high, right? Why? You see this wick stop hunt up and a move down, expansionary move down. Therefore, if you sell above this inside this order block, did I get my 10 pips? Yeah, I got more than that. 14. Okay, so these are the trades in which you can frame intraday trades from. Right? Everyone is being so fascinated with how this person and that person can trade. If you know, if you're catching my drift, so this is how you can trade up and down, left and right. Okay, strong highs, strong lows, old highs, old lows. These are areas of price in which there's a lot of protective liquidity. Once protective liquidity has been taken out, right, there is most likely definitely going to be a repricing in the opposite direction. So can you get in the repricing in the opposite direction? Yes. Since I'm talking about Euro USD, yes, I can get in about 10 to 15 pip moves, right? So that this is exactly how you can do it. So I will be hosting intraday mastery sessions. Not right now because I want to finish the algorithmic theory stuff first. And after I'm done with the algorithmic theory stuff, I believe everyone has everything that they need to know from me to actually, you know, form their model, or you know, at least take their model to the next level. And after that, once everyone can do that, then we will move on to intraday mastery, where we can take trades up and down and up, blah, blah, all that, right? So yeah. So that's the old high and old low is your homework. Okay. So we don't need this anymore. And before we continue, I spoke about the PD arrays. I spoke about the hierarchy of reactions. I don't know why I called it hierarchy. It's hierarchy of. Okay, hierarchy of reactions done. Now you see this here, right? This is your hierarchy. Oops. 4, 5, 6, 7. All right, so we have premium. And then we have discount. So when price moves from premium to discount, it's going to be checking for this. Am I looking at a mitigation block? No. Am I looking at a breaker block? No. Am I looking at a liquidity void? No. Am I looking at a fair value gap? No. Am I looking at an order block? Yes. And then boom, it goes back up. Am I looking at a mitigation block? No. Breaker block? No. Liquidity void? Yes. Then it goes back down. And then the process continues up and down, right? So it will always come to a point in which price moves from, for example, a mitigation block to looking for another mitigation block. If there's no other mitigation block, it will look for a breaker. No breaker, liquidity void. No liquidity void, fair value gap. And if it has nothing over here, it will resort to an all high and all low. All high or all low. But obviously in discount it's all low. Okay, so all low. So price will then react from the all low and go back into premium of the current range and look for the same thing over and over again. Down, up, down, up, right? It's a cycle. It's a cycle. It is a cycle. Okay, so we have that. Then that is all with regard to hierarchy of reactions. Okay. Refining points of interest. Now, when we refine points of interest, right? It's this, okay? Refining into the 1 minute, refining into the 5 minute, it's futile. I know a lot of groups like to show, okay, I'm refining 1 hour into 1 minute, 1 hour into 5 minutes. It's futile because I'll tell you why. Because on the 5 minute, okay, on the 5 minute, if you have, as an example, you have a, let's say a plus OB here. You see price is dropping, right? Then if price drops like this and then boom, then explodes higher, this portion here becomes what? Consecutive down close candles. All right, this over here becomes consecutive down close candles. So what is a consecutive down close candle? It's a bullish order block. At the same time, you have what? You have this here, breaker. Right? So you have an order block in the form of the leg down, and you have a breaker in the form of a reversal pattern on the 5 minute. Then when you switch to the 15 minute, you can't see this at all. What you see is one bullish order block. All you see is one bullish order block, right? So no need to do fancy smancy stuff and refine it to 5 minute, 1 minute, all that. Yes, if you're good at it, go ahead. But I'm just saying, don't bother yourself with it. Okay, you can still get solid trades with looking at 15 minute structure as well, right? So think about that, and do some studies on it, because that will be quite important for your daily trading, because sometimes we tend to be stuck on a smaller time frame and we lose sight of what's happening in the larger ones. So if we stay, let's say, in a time frame that's intraday and at the same time gives us information about the previous days, we can use a 15-minute chart, right? We can use a 15-minute chart. So on something like this, we can see exactly what happens. Now over here, we have this entire thing is what? Down close, right? So on the 4 hours, it should look like a order block. Then here, actually here, this low to this low, price moves up explosively. This here is your breaker. So you have a consecutive down close candles as your order block, and you have this as your breaker. Then if you look at the 4 hour, you just have a order block. If you look at the 1 hour, you have a big order block here, a very big order block over here, right? So think about it, and do your own studies on that, because if you can gather up a lot of data about the very basics, it becomes very easy when you just look at the charts. Okay, it becomes very easy when you just look at the charts. So that's that. Refining points of interest, go up to the 15-minute. And if you really want to get that very, very tight stop, just go to the 5-minute. 1 minute is not even necessary. Okay, not even necessary. Stop hunts. After that, better. So on stop hunts, it is a price signature that indicates a range expansion or range creation. So stop hunts, as I just said, it indicates range creation, right? So in terms of range creation or range expansion, a stop hunt is essentially the beginning portions of an institutional swing high or an institutional swing low. Now, why am I saying institutional swing high, institutional swing low? If you watched ICT's YouTube video, I can't remember exactly which one it is, but he showed examples of short-term highs, short-term lows, intermediate-term highs, intermediate-term lows, and long-term highs, long-term lows. Okay, they form like this. So it is a 1, 2, 3, 1, 2, 3. So what does this mean? What does every bullish swing point mean? What does every bearish swing point mean? Every bullish swing point is a buy program, meaning market maker buy model, and a sell program is a market maker sell model. So if you can understand when these points occur from a fractal standpoint, you will be able to understand when the next range expansion will occur, when you can expect that next range expansion to occur. Because if you look at this on the 5-minute, right, on the 5-minute, and if you look at every range expansion over here, starting from this portion here, okay, starting from this portion over here, we can see that we have a swing high, a swing high, a swing high, and then we broke here. We broke over here, right? So once we broke here, we have that, right? So this indicates that when price comes back over here, it's going to create another range. It did it over here, it did it over here, it did it over here, and that's pretty much it, right? So we had range creation here, range creation here, range creation here. So this is only one spot, right? But if you look at this, if you look at this here, you had 1, 2, 3. Price comes up near the third point and sells off. You have a sell there, right? You have a sell over there. 1, 2, 3. See, price goes lower, comes near the third swing point and sells off. 1, 2, 3. Comes near the third swing point and sells off. Right? So this is something that I believe you need to practice, because it took a lot it takes a lot to actually identify it happening in real time. But when you can identify it happening in real time, you will, and here's my hint, right? You will see that when these swing points form, it would be best if you see something like this and something like this. Stop hunt, which is what I'm talking about, stop hunt, and then a break, right? And then a break. Price will come for inducement here, and that's where you set it off. And this is where you should use the inducement templates. Okay, this is where you guys should use the inducement templates, because ICT, right? His concepts, or smart money concepts, as one would say, is central to swing highs and swing lows. Nothing else. Everything that we speak about, fair value gap, institutional order flow, entry drill, mitigation blocks, a run on a strong low in the middle of a range, a run on a strong high in the middle of a range, it's essentially working within the anatomy of a swing high and a swing low and its range. Okay, so what we are doing as traders, as smart money traders, is we are trying to determine when the next leg over here is forming so we can get in over here. This is our low risk buy. As a smart money trader, we are looking at something like this, and we are looking at when we can catch this move here so we can catch the low risk sell. That is all there is to it. And so in trying to forecast, right? Let me get to a blanker part of the screen. In trying to achieve this forecast of when we can get this portion, right? In trying to forecast this, what do? We employ premium discount, we employ interbank dealers range, we employ the PDRA matrix, let's call it PDM, right? We employ all of them just to get what? Just to see when and where we can expect this move to happen. That's all there is to it. When and where we can expect this move to happen. Now, of course, it is algorithmic in terms of certain things should happen before it reaches that point, but it doesn't change the fact that ICT's trading is central to this. Okay, price moves in algorithmic steps to complete a swing high formation and a swing low formation. That is all there is to it. Okay, and it is with these concepts that we can reasonably place our entries at a spot where it's most likely to sell off or it's most likely to rally in our direction. All right, most likely rally in our direction. So we use concepts like displacement, like I just said, premium discount, the bullish algorithmic model, bearish algorithmic model, right? So now if you look at the bullish and bearish algorithmic model that I sent you guys, notice everything is on a step-by-step basis, right? On a step-by-step basis, meaning that we always want to see an interbank dealing range. An interbank dealing range, institutional order flow entry drill. I haven't used it. I haven't used institutional order flow entry drill much, but it is a way in which you can enter on a price expansion via a move back into a fair value gap. Someone correct me if I'm wrong. Right, so yeah, so that's basically what we do, right? What we do, we employ all of these concepts to get the final point of the swing. Final point of the swing. So we have the breakers, we have the order blocks, we have the fair value gap, we have all of that, and those are what will help us achieve these trades or in getting these trades, right? Now, like I was saying, if you guys have read the PDFs on the bullish and bearish algorithmic models, I broke it down into steps, right? So the first step is creation of an interbank dealing range, because we need a dealing range to see where it's going to happen, because we know smart money wants to sell at premium and buy at discount. So if they are in a bearish range, they want to sell at premium, right? So what's at premium? It could be a breaker. If the breaker has been mitigated, it could be an order block, right? So those are stuff that we need to work on in terms of pattern recognition. Okay, in terms of pattern recognition. So right, so that's pretty much it. Stop hunts, price signature, refining points of interest. So you don't even have to go below the 5 minute like all of these people tell you to, and how they show it on social media. Hierarchy of reactions, PDRA matrix, know what you're looking for. ICT, external to internal range liquidity. I did skip that, right? So yeah, I did skip that. Right. So ICT, external to internal range liquidity. When we speak about algorithmic theory, I will debunk this and I'll tell you exactly why it's not external to internal range, but it's actually something else. Okay, it's actually something else. And it's a reason why he calls it this way, it's actually something else, right? So I will talk about that next, maybe in 2 weeks from now, because next week we have enough of work to do with the other models, right? So we have that. So in terms of looking at the normal external to internal range liquidity, we know that external range, which are denoted by E, and internal range denoted by I, is the old highs and the old lows. And the internal range would be the order blocks. Okay, the internal range would be the order blocks. So what does this mean? This means that when price takes out an external range liquidity, it's going to seek internal range again. And the cycle goes on. It's as simple as that, right? But the context should be there. This doesn't mean that every time a old high is, for instance, it doesn't mean that every time a high is taken, it should go back down. Doesn't mean that, right? So it has to be taken with context. That's pretty much it. So that is pretty much it with regard to today's thing. If anyone has any questions, I will be happy to answer. And looks like Euro USD ain't looking so good. But yeah, anyone have any questions? Say. If no questions, we can go off record and we can speak about the daily review for today. So no problem, no problem. So you just forgot about external liquidity. I sold EU because on the lower time frame, it showed a change in the state of delivery, but I think it was too early. Seems like it's too early. But it is what it is. Tomorrow, Bitcoin. Right, so tomorrow is Saturday. So on Saturday, I will be speaking about. Oh wait, what about the rest? Anyone else have any questions? On Saturday, I will be speaking about. Tomorrow, market structure, counter trend, pro trend. Going to be a short session, but yeah, it's going to be informative. Right, so no questions, anyone? So I can go. I can speak about the daily review for today. So I can stop recording. Someone say something. Okay. Oh, good. Oh, good. All right. All right. Let's do it.